Welcome to stockmarketpunting.com, and here is a wonderful, wonderful way for everyone viewing the video to start their July 4th in the morning. And what we're taking a look at here is the 175 put on Priceline.com, and we're also looking at the 175 call. So that when we are buying wholesale over here and wholesale over here on both ends of the market within the price action, 175 had a previous day, it had a high at the day before was $11, but you can see the intraday high was $10.50 and the low was $7.10. There was a market made right in there by 3.40. And basically when the value of the put was going down, you were buying the 175 put off the lows, because the SMF master trading system prints this side of the market and you get it wholesale there. And you can also, at the end of the day, buy these wholesale down here, because you've already made a good enough turn right here in that 175 put versus the back end value that dropped over here, or you could say value dropped from 10.5 off the high at 7.10. And that created a 4.21 to $6 high. Notice that they're both the same strike price, but one had a much higher range. The 175 call for the strike. The 175 put, which is slightly in the money, was very narrow. That means that the market makers themselves are they're not giving premium. So you got some people that are hijacking premium. I can just tell by looking at everything here, by looking at this side of the market. And I'm going to pause the tape and I'm going to move out these level 2s on the various options exchanges. However, remember, when you're learning the SMF Master Pro Trading System, you will be in a position to simply tick this side of the market that way. When this side's going to lose value, this side's going to go up. So the call side of the market's in a suffering mode. And this is where you want to be trading, is the back end there, because it can't get above. It was failing at prices. So I'm going to pause the tape. Priceline.com. We would like to point out to you that the weekly low level here, and it's a weekly chart up here. Okay. So basically it was $1.75 for buying the 175 put option. It's right there. Your high was 7.70. So when you're buying the back end of the position, you got that great move. So let's say you paid $2 a contract and you had 20 contracts. And you're selling up here at the high around 7. Let's just keep it even numbers. 7.70 is the high. Say you sell at $7. Well, you do the math. You made a very nice profit, because you made $6, well, $5, let's just say $5 a contract. That would be a $10,000 trade right here. That's exactly what that is. When we got down here, we were in a very deflated area, considering that the same 175 put 3 weeks ago was up at the highs of 1239. When it got down here in that deflated zone at $1.75, and the intraday range was $1.75 to $4.60, so it was bottom up. And that was even a nice spread there on 20-30 contracts, because once again, that's deflated. Now, let me show you the other trade. Right here in the video, you can see the weekly call chart, 175 call. You can see where the call contracts had hit $25. And we all know that 175 call, that's the strike price, and you have to travel much higher above the strike price in order to make money on that purchase. The high was $27.30. The low right now printed on Friday at $7.10 for that call contract. And on Tuesday, what we are going to be doing is looking at where that next bid is in that market, which we know because we teach you market maker skills. Not a lot of things, and everything that we do at SMF is based on price action, wholesale to one side, wholesale to the other, and always dumping back to the retail side of the public. That's what our operation is here. That's what we do. So let's make that clear. So really, what I am coming down to on a weekly basis up here on the call contract is if you look at $25 and you subtract that, just call it $7. That's how much value the call has lost in a 3-week period. 1 week, it lost money here. It went from 20 clear down to 1480 or whatever it was. 1580 was the open for the week. This is a weekly chart, so 1580 was the open, but you did have a high of 1590 and a low of 6.7 right here. And you closed out, looks like at 710 right here. So the previous week they slid that bid from 20 down to 13.90 the prior week. This last week, which was your holiday week, what they did was they slid this bid pretty good. Okay? And that was 1590 down to that low, and that makes that a deflated zone. And we start looking at buying this side of the market at our next market action bid and ask that we know. And I'm not going to put that on a video, but I will be telling our traders where these price levels are. We're going to be setting alarms on this side of the market. Basically, what we're going to do is we're going to take moves out of both sides of the market. Because when one piece of the market's failing, the other side of the market is ticking higher. And people totally lose consciousness of that. And they are paralyzed